All right. Good morning, everybody. Sorry about yesterday. Hopefully, everybody was notified soon enough. Power outages throughout the entire county lasted through most of the night and into the morning. But I live on top of a hill, so they can't wash me away. They can just take away my internet and my power and everything else. So, markets are flat mostly around the world, waiting on data, of course. We don't have anything else to do. It was interesting. I went out to dinner last night. Of course, there was always something playing in the background, and the headlines were, the world's at war and the markets dropped and oil popped. And I thought to myself, well, what markets? Did you guys notice the markets, crashing and burning yesterday? Because I didn't. And why not? Right? We're just holding the line, waiting, and that's kind of what it seems like. Everybody's waiting for the excuse, the trigger, the reason. And we have a lot of reasons. Why are we not going anywhere? So it's triple witching. It's a short week. It's FOMC. There's a lot of bricks in the wall of worry. We have inventories today, and it should be for nat gas and crude, since we normally get nat gas on Thursday, and we're not going to be here on Thursday. So watch the inventories today. Um, I've heard a lot of people already talking about shorting crude. Just be mindful that this situation can last longer than you. And so, the old adage about markets can stay irrational longer than you can stay solvent. Well, that's a real deal. It comes from, years of people getting run over. So yes, eventually crude is going to be a short, and shorting it from the highs is always the best opportunity because it's an LRE. But an LRE, or a low risk entry, does not mean it's not risky. It just means you're risking less capital. So it can still be a risky endeavor, risky behavior, but we would call it a low risk entry because if you wait for confirmation, you pay for it. So, getting in before the short is confirmed risks less capital. But there's going to be a collar or a floor to that because inventories are already light. I didn't get a chance this morning to dig out the data, but I believe the U.S. inventories are 10 million barrels light already. And when we get the data today, it may show that we, are off a little more. If you look at the pumps, right, you go get fuel, gas is really cheap, right? In my area, it's not even $3. And depending on, if you're willing to shop around at some of those cheaper stores, at the not the premium gas, you can get it close to 250 a gallon. And it is that way because they're using the petroleum reserves to keep it that way. Well, they're going to run out at some point, and the cost is going to go up either way. And that's really going to hit the broader market. So there's times I know where we just discount everything and we all focus on the hyperscalers and the Mag 7 and ignore everything else. But at some point, you can't ignore crude, especially when it gets into the cost of manufacturing and production, shipping, And we already seen airlines starting to get some attention. So, that's usually the first group, which it should be, right? Just stay nimble. So Japan down a 0.5%, the NASDAQ up not even a quarter. Just waiting on data. It's very likely that the crude data today, because of FOMC today, won't be market moving by itself. Very likely, right? But the data we get today will set us up for what lies ahead when it comes to crude. Just run it one piece at a time. The housing numbers are so close together. We're not expecting anything there. Jobless claims also really close together. We could always get a surprise. So just because the projections show that we don't have, in a disagreement, just be mindful, as always, that when we get data, any outlier or shock to the system can absolutely move the market. So even though they're not projecting that to happen, that's usually when it would happen, right? If they were projecting something really wide, something nasty to happen today, and the numbers come in light, then that would be completely different. It's the shock and awe that catches the market. I thought we were going to get some headlines out of Japan, and I'm a little surprised, maybe disappointed we didn't see anything. And keep your eye on the Canada today. They were going through that G7 this week, and they're going to be chipping teeth today. We could hear something out of them. I'm still not seeing anything on the nat gas. If they don't give it to us today, which they should, since we're not going to be here tomorrow, then we'll get it on Friday. Bitcoin might get into play today, especially if everybody's waiting and we're all in a hurry up and wait mode everywhere else. We've got the crypto czar chipping teeth. So Mara, Hut, Hive, Coin, MSTR, and all those. Oh shoot, Firewheel. I can't remember the new phrase for those companies that are low float penny stock trash, and they are just buying a bunch of Bitcoin. Anyways, you guys have probably seen my posts on it. Those names could get some attention today if everything else is sideways, right? There's always something moving. That'd be the idea behind it. If we're not moving, find something else, at least into 2 o'clock. All right, we've started the stock buyback blackout period. That kicked in this week. Tomorrow the market's closed and the G7 is done. So that pretty much wraps up anything on the docket that was other than, OPEX and FOMC. The levels have shifted, right? We can see the call wall and the put wall. We can see it all now, all on the screen. We don't have to zoom up or stretch the charts. It really feels like they had the call wall brought down. I didn't catch yesterday's level here and to list it off, but I think it was 61 something. Either way, everything's bunched together. So keep your eye on them. If they roll the call wall up or the put wall down, that'll be a tell. It would be bearish to move the put wall down. It would be bullish to move the call wall up. Right. And it's just a little bit of bias. We're not talking about, pouring capital into the system just because the call wall got moved or the put wall got moved. It's just one more piece of information. Outside of that, we're still above the 10 this morning. The 310 are coming together into a pinch. It's likely that we get a surge signal. If you're unfamiliar with the phrase, it's when price crosses the 3 and the 10, and then the 3 crosses the 10. That can be a bearish surge or a bullish surge. We just take it out on the daily here for a moment, just sort of scroll back to a point where we had such an incident. Price crossed through the white line is the 3, and then the blue line, which is the 10. So price cut down through those, and then the white line crossed the blue line, and that is a surge signal. If you take it the other way around, price crossed the white line and the blue line, and then the white crossed the blue line, and that was a bearish or a bullish surge signal. Moving averages work better when they run in pairs, right? It provides depth. This is the range or the focus right now. So we've got 6,100 on the upside, 59.50 on the downside, midpoint 60.32 cog line. And we're looking for a higher low here. So we just start to zoom out a little bit, see if we can find a sweet spot into all that. So we got our high. We've been setting these higher lows. We need to set another higher low here. And then a new higher high. We don't want to break that low and then break that 6,000 low. That's really the one we want to focus on, the 6,000. If I take this and put it back on candles, we wouldn't count this, right? We would count this. So we're in a hurry up and see mode at this point. We have the key level above and below. One of these has to break. That's kind of obvious. If we break that 59.50, that sets us into a lower low. And of course, we can still develop a complex topping pattern because that lower low by itself doesn't develop a downtrend or a reversal on its own. That's still where we're at. Situationally, we're just still in a complex topping pattern. If you read the Spot Gamma's evening note, they talked about Captain Condor taking a pretty good sized loss yesterday. Um, we've seen that happen before, and he usually doubles down. So I'd look to see in the AM edition founders note if they have any comments that might give insight on the levels he chooses today. Otherwise, look for his positioning in the SPX. We can't use the market maker move this week. It's a short week and it's a contract change week, and the market maker move gets all wonky on contract change week, so we can't use it. Even if they are hedging this morning, we wouldn't know it, right? Because of that. And if they were going to hedge, it would be expected they would do it later today, closer into the FOMC, not this early in the day. We're only up a marginal amount. So while we're closer to one edge than the other, it's not by much. We've got an 80-point range, which feels, pretty narrow compared to the 120, 150 range that we had back in like March and April, May. So the ADR continues to shrink. And at this point, we can hit the upper ADR easier simply because it's inside of yesterday's range, right? We just highlight all of yesterday's range. You could see that we can hit this line easier because we don't need an inside day breakout to do it. Having said that, we already broke out of yesterday's range. We did it at the open, and then we came right back in again. Now that we're back in here, we need to keep it. It's just the function of things, right? It's how it works. So breaking out right at the open and then correcting the problem and fixing it, that's one thing. But if we get back out of the box now, it's not a good deal. So if we do get out of the box, which is yesterday's range, break our own Globex low, and the target is 59.92 cog line or this lower ADR here. That is a really nice setup. It's like the best one we have for the day. Otherwise, break the Globex high, and we can target the upper ADR here, 60.71. Get through that. We've got the RTH high of yesterday. $10 points. I mean, it's not bad. I'll take it. 6 to 10 contracts, 10 points. That'll do it. Day done. Once we get through that, we can target the high of yesterday. And if we get through that, got the high on the week, 61.11 cog line, which is also the full ADR on the upside. So level by level. They're not quite equally spaced, but it's close enough. Really, it's not bad, all things considered. So we've got our play in both directions. We just need it to come through. This lower ADR at 59.50 would be the last hurrah, kind of the line in the sand before things start to get really nasty. 59.50, we need to stay above that at this point. Don't even want to test it. We're still above the weekly pivot, and when we are above the weekly pivot, we say that we're in a bullish backdrop. it's hard to argue that you're in a bullish backdrop when you continue to fall, right? So that sort of logic always screws new traders up. And I get asked about it all the time. Hey, we're above the weekly, so we should be bullish, right? Yeah, that's what they say. And then you get that sort of behavior. So how's that work? You should be looking for long setups when we're above the weekly. But obviously, if you're falling, you don't have long setups. So you don't have anything to take. That's how it works. Yes, you should have better luck with long setups. But if you're falling, then you don't have any long setups and there is nothing to play. If we continue to fall, that is the target, 59.92 cog line, which we'd already laid out, right? 59.92 cog line is in front of the 59.50 that we continue to say is the line in the sand. Today's floor pivot is lower than yesterday's. That's bearish. Price opened underneath it, and that is bearish. It's a wide channel, more narrow than yesterday, but still a wide channel. Wide channel implies that if we break out, it won't stick. Well, we did break out, and it didn't stick, and we came back in again. We can still break out. This channel doesn't make price do anything. Last week's point of control, we broke right through it. Nothing there, right? No help, no assistance, just this distribution. And it really didn't help us out. It was the entire value area. We broke out of the value area on the upside, and you could say we tested the lower value area. We came back in again. But for this week, we don't even have a clean distribution. It's just a big block of trash. So really don't have anything good here. And if we zoom out, we can see the stack, how it's been getting higher and higher and higher. And at some point it's going to roll over, but you know, that's what they've been saying since the April 7 capitulation when the president backed away from all the tariff talk. And we've been running up since then, right? That's this whole run here with higher stacks and higher points of control and on and on and on, right? We have left some really big gaps behind, and it does seem like we're stalled out at 6,100, but we learned using the RSI Laguerre that markets can go sideways, not because they've stalled out and they're broken and they're going to reverse, but because they're building up energy for another leg. So the fact that we're holding the line here doesn't necessarily put us in a bearish bias by itself. Ten-day volume profile and TPO, the point of control is lined up really nice, right around that 60-32 cog line. And we've got a classic distribution. I gotta say, it's been a while since we've had a classic distribution on this time frame. Really, it's been a long time. So it's nice to see. But on the other side of that, we got nothing here. We're a line in the sand, and above it and below it, we're putting in a lot of work at these two spots right along the value edge, value area high and low. So not really helpful other than just validating what we already know, that these 3 points offer a lot of value. Thanks, right? Like, no kidding, Captain Obvious. So that's what we have. GTFO, if we get out of this, we can expand. That 6,100 isn't going to slow us down, and or that 6,000 isn't going to slow us down. But once we get out of this range and we try to come back, that's when it's very likely to act supportive or resistive. As long as we're still dancing around in here, we can cross that point of control and it's not expected to impede us in any way. The TPO and point of control on the 5 minute, they're not lined up. Just a minor discrepancy. It does look like the TPO is going to catch up in a moment. Double distribution from yesterday really stands out. It highlights how that 60-70 is likely to give us some shade or give us some trouble to the upside. So if we do get a break up there, keep it in mind this afternoon, right? Think about 2 o'clock or 2:30, FOMC, big candles. If we happen to pop to the upside, watch that 60-70. I would put that one on the table today. The point of control from yesterday, the textbooks would tell you to carry it forward anyway. So if you carry that one forward today, that would be your 2 distribution levels. And of course, we have this level from Monday, which we didn't mark because in the Globex between Monday and Tuesday, we opened and we cut right through that line. And I said, well, I don't want to mark it because we've already hit that level. But it wouldn't hurt just having it on the radar today so that if we do go up there, you got a level to be concerned with. $16.92 cog line. Imagine that. Just marking them. I don't want to keep them, right? Putting them on the table so we know where they're at if we happen to make moves in that direction. Otherwise, no, there's no gap. We got the VPOC to the downside and last week's low. So Friday's Globex low and then Friday's entire low, the whole thing. I got busy and I did not get the hand-drawn weekly levels. If I remember this morning, I'll get that taken care of and I'll share that in the chat for anybody who doesn't have Thinkorswim and can't go back. We're still above the 10-day, just holding the zone. This band of price. Not expecting anything as long as we stay within this band. It's a bit like gravity. We just hold in the line and chopping back and forth. But it does show that we're healed. We're fine. We haven't done anything wrong. And from here, it's like a full tank of gas. We can go as far as we want. %3 above the 10-week. It's still it's a bit stretched, but compared to where we were, we're backed off a bit. It's nice. So at this point, we could still just hold the line and chop and heal. This going sideways is a nice way to correct in time rather than price. On a morning like this, guys, FOMC short week, you are very likely not going to find much moving, right? If we're sideways in the indexes, then 80% of the market's going to be sideways, but there will be something. And that's the idea. If you're still looking to day trade, you want to find something to trade, just stay away from the sideways trash and focus on something that is moving. Silver, copper, right? Commodities are generally still going to give you something to play today. Crude. So from that point of view, we'll have something somewhere. Otherwise, I know a lot of people who take the FOMC day off or the entire FOMC week. Now, I think the whole week is a bit extreme. There's still plenty of trading opportunity. No reason to miss the whole week. But if you're newer to trading and you are already struggling, then trying to trade an FOMC day is likely to hurt more than anything else. So just kind of keep that in mind. With that being said, when we look at what's left, what's moving today, we got Bitcoin. And don't forget that czar today at the White House is going to be chipping teeth. And we already want to have our eye on Bitcoin. And we've got chips. And that's to the upside. To the downside, we got the VIX and a little bit of China. So China had some economic data that came in and really lit them up kind of nice earlier in the week. But if we look at things over a 5-day period, they've basically been flat, a little bit up, a little bit down, really not getting much from either side. There was a question about the Thinkorswim web version versus, like the desktop or the mobile. Thinkorswim on the web is the only Thinkorswim app that will allow you to go from paper to live without signing out. That is the one redeeming feature of the web version, is the fact that you can jump from paper to live without signing in and out every time. So if you're paper trading, say, options trades, using the web version to be able to jump back and forth is a really good way to do that. Also, you can log into both at the same time without having, different computers. I run 2 computers at once, so having Thinkorswim on twice is no big deal for me. But if you use the Thinkorswim web version to manage trades that you're in, whether it's paper or live, then you can use the desktop version to do whatever it is that you're doing. The web version is also not really set up for analysis. It's more of for monitoring your position, putting new ones on, that sort of thing. So from the option side of things, the risk profile looks more like Tasty Trade on the web. So it has, the red and green shaded area to make it a little more visual or user friendly. So it's just recognizing what they made it for and where to get the best value out of it. So use the web version to monitor your trades or positions, to close them, manage them, adjust them, or to swap back and forth between paper and live. Other than that, it doesn't have your analysis that you would want. It doesn't have all the advanced features that you would want. I've seen it break when you try to use any of your custom indicators, just like the mobile wheel. So, and also look at it on your mobile device, right? We all know that there's a Thinkorswim mobile, but go to the web version of Thinkorswim on your mobile device and take a look at it. It does offer a little bit of help there compared to the mobile app. So we got chips in this big range. GTFO, as it has been for a while, that 265 line in the sand. And we're building up like a little bull pennant up here. The low is in. I'd give it a little room and say 255. So it's a 10-point range. Really nice box. If we get out of it, we've already got the zone lower, that 240 area. And if we get above, then we've got that 270. So, it's like 5 higher if we go up and 10 lower if we go down. As usual, there's a better risk to reward right now in a short. And it's not because of statistics or odds, really. I was going to say it's not because of like technical analysis at this point. It's more of probabilities and odds. What's more likely after having run already this far, that we go higher from here or lower from here? It's more likely that we go lower from here. That doesn't mean that we have to, right? So if we go to the downside, we got a 10-point play. If we go to the upside, we got a 5-point play. Risk to reward wise, you'll have a better RR on a short. We don't want a rally on nat gas and crude energy. And we got nothing. So watch commodities, keep your eye on Bitcoin. Get out of the box for the levels that I had already laid out. And it should be a fairly easy day, all things considered. Just keep your patience, right? It's very likely that we go sideways most of the day while we're waiting on this data before we finally start to make the move. So simple enough, right? Get out of this range. And you can play the levels that I gave earlier. So what I got for you guys, be careful, be safe, watch the clock. I'll see y'all